Hi everyone, good morning. This morning I'm going to talk about the golden rules of debits and credits. In other words, how do you decide whether an account should be debited or credited for a particular transaction? So in accounting cycle, this is also called transactions analysis. What we do here is we analyze a transaction, we dissect it, bisect it, we split it into small pieces and try to see how it affects the accounting equation. You know the accounting equation, the classic accounting equation is assets equals liabilities plus stockholders' equity. That means at any point in time, your total assets will be equal to the total of your liabilities and your equity. In other words, if your assets are say $100, if you take away your liabilities, which is say $70, then the remaining $30 is your equity. So the more assets you have, chances are if you don't increase your liabilities, your equity is going to go up. So I'm going to show you the accounting equation here. So take a look. This is the accounting equation. Assets equal to the total of liabilities and stockholders' equity. So what happens when a transaction occurs, it affects our financial condition. We say that the very definition of a transaction is that it is an economic event. That means the transaction must have affected at least two of your accounting equation elements. So it is possible that because of a transaction, one asset goes up while another asset goes down. So that's a fair transaction. Like if I purchase supplies for cash, or if I purchase an equipment for cash, if I purchase a laptop computer for cash, then my laptop computer comes in, so an asset goes up, which is equipment, and another asset goes down, which is cash. So it is possible for a transaction to just be confined within the asset side of the accounting equation. Then let's try some other transactions. Let's say you have you purchase supplies on credit, or you purchased a truck and didn't pay the full price down upfront. You pay, say the truck costs $80,000 and you paid only $10,000 upfront, and you signed a note for the remaining $70,000. So your assets are going to go up by $80,000 because there's the truck. Then another asset goes down, cash goes down by $10,000, and at the same time your liability, one of the liabilities is going to go up, which is notes payable, by $70,000. So here we have a transaction. It's called a complex transaction where there are going to be one debit and two credits. I'll show you which account will be debited and which accounts will be credited. Now look at a transaction where there is a decrease in an asset and a decrease in a liability. So let's say you pay off a loan. So when you pay off a loan, you use your cash to pay off the loan. So your cash goes down and your loan balance, which is a liability, also goes down. So that's a fair transaction as well. What happens when you pay dividend? Your asset goes down, which is cash, and your equity goes down. What happens when you issue new stock, new shares? Your asset goes down, asset goes up, which is cash. Presumably you issued those shares for cash. So assets went up and your equity, stockholders' equity, common stock, would have gone up. So now the debits and credits are based on those changes in the accounting equation. The change, remember, up or down, increase or decrease. So I would like you to memorize just one key element, one key word. And that key word or key phrase is that when assets go up, we debit it. Remember, when any asset goes up, you debit the asset. And then the remaining changes, the remaining parts of the journal, there is no need to memorize anything. Why? It just follows the logic. Because when asset goes up, if we debit it, then when assets go down, what do? We'd credit it, isn't it? That's common sense, that's logic. If cash goes up, it's cash going up is debit, then cash going down should be credit. If equipment going up is debit, then equipment going down should be credit. Because you know that if going up is debit, then going down, because they are diametrically opposite. Now, so that's one part. Assets going up is debit, therefore assets going down should be credit. Now look at the other side of the equation. You have done from grade 7 or grade 8, you have done equations. You know that when you switch sides of an equation, like x equals, say, y plus z, then if x goes up, something on this side must have gone up. Or if you switch sides, they follow negative, they follow opposite rules. In other words, if I move something from the left-hand side of an equation to the right-hand side of the equation, we change their signs, isn't it? So if something was positive while it was on the left-hand side, it becomes negative when you bring it to the right-hand side. In other words, the rules for assets are totally opposite to the rules for liabilities and equity. So what was the rule for asset? For assets, we saw the rule was that asset going up was debit, asset going down should be credit. Therefore, just apply the opposite rule for liabilities and equity. Liability going up would be credit, and going down should therefore be debit. And likewise, equity going up should be credit, and equity going down should be debit. So there we go. That's our accounting equation, and those are the golden rules of debits and credits. So see, we said assets up is debit, therefore down should be credit, isn't it? Up was debit, down should be credit. And for liabilities, up would be, if up was debit here, up would be credit here, isn't it? So if it is credit, then down should be debit. Credit, down should be debit. So this is how we apply the rules of debits and credits to decide our journals. So I'll just give one example. Go back to supplies example. We purchased some supplies for cash. So one asset has gone up, which is supplies. So asset going up would be debit, therefore supplies would be debit. And asset going down should be credit. So which asset has gone down? I paid cash. So cash has gone down, so cash should be credit. So the journal is for cash purchase of supplies. The journal is debit supplies and credit cash. And same for any asset you purchase and pay for it. The one coming in would be debit, the one going out would be credit. The one increasing would be debit, the one decreasing would be credit. And for liabilities, just apply the opposite rule. Any liability going up would be credit, liability going down should be debit. Equity going up would be credit, equity going down would be debit. So every time you borrow that liability account, notes payable, mortgage payable, bonds payable, accounts payable, every time you owe people money, more and more owing means that account would be credited. And every time you pay off those loans, that account would be debited. Same rule for equity, opposite rules for assets. All right, I hope it works. Thank you for your patience. Enjoy watching. Thank you. Bye-bye.